All right, what is up, traders? What's up, tycoons? Super excited for today's video. Moved into the new place, got the office set up enough to where I can start recording some videos, and we're going to cover. This is basically like my favorite type of content to put out there. Okay, we're going to be doing institutional grade analysis and highlighting some very key important divergences in the market. Right, we're going to take a look at the relationship between stocks and the dollar and the divergence there. We're also seeing gold diverging from its typical relationship with the dollar. All right, we've got some major divergences here across a few ratio charts. We're going to go over the Dow transportation theory, and then we'll take a look at growth versus value, all right? And also the divergence that we're having right now between Treasury yields and the stock market. And then we're going to take a look at a ratio chart of the Magnificent Seven stocks versus the S&P 500. We're right here at a very critical retest. This is going to be a big factor on whether or not we could see a potential pullback in the market this upcoming week, or whether or not we see a nice little rebound in the market, that chart specifically. And then even when you take a look at the McClellan's, right, whether it's the McClellan Summation Index or the McClellan Oscillator, we have some very key divergences. All of these divergences that I'm highlighting in today's video are something that could potentially lead to a correction, a market correction this quarter. And as you can see, and as we go over in the video, these divergences have played out many times in the past and are very good signals. All right, we've also got one here with the stock market and oil, okay, and oil futures, the relationship between there. We're going to take a look at the put-call ratio as well. Some people often use this as a contrarian indicator. We'll go over how to do that. And then we have a risk-on ETF and a risk-off ETF. We see the risk-off ETF breaking out here. And then, we'll just take a look at some of the market dynamics, okay, because this bull market, which we still are in a bull market, is completely different than the one that we saw in 2023. We're going to cover that and show some of the main things you need to pay attention to right now. We've also got, the equal weight versus the S&P 500 right here. This is another really important chart I'm watching. We've got a little bit of a projection tool, a seasonality projection tool, and then we've got the skew relationship with the Skew Index, all right? And also we're going to take a look at the percentage of stocks above their 200-day and 50-day moving averages. We're also seeing a divergence here. And then when you go to the bond market, right? A lot of times people say the bond market knows what's best. We're seeing divergences here again, whether it's in the tips versus the NASDAQ or TLT versus the SPX, or even just the advanced decline line, right? And also in copper futures, okay? Copper, they call it Dr. Copper, is a very important indicator used by some people, many people, to get an idea on the state of the economy. And we'll take a quick look at the relationship between copper and the stock market, and then we're going to talk about volatility, right? We're going to mention the VIX, the VVIX, and break down what we're seeing here in volatility. So it's going to be a jam-packed video, very, very useful information. You're really not going to find info like this video specifically, really much else on YouTube. Lots of people are charging hundreds or thousands of dollars, to institutional and retail clients that put this out. So be sure to smash the like button, subscribe to the channel, and you're going to want to stay tuned to the end so you don't miss any of these important charts. As always, though, the content provided in this channel is for informational and educational purposes only and is not intended to be relied upon as legal, financial, or investment advice. So be sure to read through the disclaimer. And if you're new to the channel, I started a completely free newsletter called Investment Intelligence, giving out free, valuable finance and trading content related to the markets. I also try to sprinkle in a free trade idea in there about once a week. You can see some of the previous newsletters because there's a website associated with it. So you can check out the website and read, review some of the past articles and see if it's something that you want to subscribe to and get sent directly to your inbox. You can also join the Investment Intelligence Discord. It's only $10 a month right now. Now that the first quarter is over, probably going to start upping the price just a little bit on that. That's where you get all my analysis, all my trade ideas, as well as custom scripts, indicators, valuable resources, such as being able to see dark pool levels, such as being able to see gamma levels, and many other things. So links are in the description for all of those. And These are just what some of the analysis and the trade ideas look like in the Discord, right? I'll post, the chart patterns that I'm seeing. This was in the solar space. Then we've got one here on Intel, just highlighting, the key levels, and going over what I saw. There's a really huge order block there too. That Intel trade worked out very nicely. And let's get into it, okay? So the first chart we have here is SPX on the top, which we're going to use that to represent the stock market, okay? And then we have the dollar on the bottom. Now, as you can see, they have an inverse relationship, right? As one is moving down, the other is moving up. As the stock market is moving down, you also see this moving up. And we've got this weird period here where we are having these divergences, okay? Now, we had this period here where we are rising, and when the dollar rose, that's actually when we saw a little bit of a bottom move up, but it's a little bit easier to see on a weekly time frame, right? So this chart right here is a daily, all right? And, you can see that there still is a little bit of a divergence here, but on the weekly, it's a little bit clearer. And one thing that I want to highlight to everyone is if we take a look, we're right around the same length of time almost. Okay, we had about a 4-month divergence here between the dollar and the stock market. And that ended up leading to a rug pull, right? We actually ended up seeing a rug pull in the S&P 500. And here we are yet again with another 4-month long divergence. So the big question is, could this potentially lead to a rug pull, right? And when I say rug pull, I don't mean the start of a new bear market where we're going to drop 20+%, but rather just a little bit of hyperbole referring to anywhere from a 5 to 10% correction is something that I would be expecting. And we can even see the dollar and gold diverging. Okay, so what we have here is actually the inverted dollar in green. So as the green line here is moving down, this means that the dollar itself is actually going up, right? And so we can see by how closely these charts trade in pairs and in similarity and in fashion, we can see that, yes, the dollar and gold typically do have an inverse relationship. And what do we see here? Well, we see the gold chart absolutely skyrocketing and breaking out. Okay, but the inverted dollar has been dropping, meaning that the dollar is also going up. So we're seeing this now, even a divergence in the gold market in some of the commodities markets. This chart right here, this is one of my favorite charts to look at, and I'm going to explain it to you guys really quickly so you understand. We've got the stock market SPX up top here. Okay, now this is a ratio chart of high beta to low volatility stocks. In a bullish environment, you're going to see high beta stocks outperforming low volatility stocks. And what we've seen since December of last year is that high beta to low volatility ratio has been sideways. Okay. Now, this is, if we were to do some technical analysis here, this is on the verge of a potential breakout, right? You could say there's a little bit of an ascending triangle right there. And we would look to see if this can break out. That could be a signal that, hey, the bull market is going to continue and everything is fine. But when you look at discretionary versus staples, okay, which is also another ratio chart that typically in a bullish market environment, you're going to see consumer discretionary stocks outperform. And yet again, we're seeing a negative divergence here in this one, okay, ever since December of last year. Now, one big reason for this, in my opinion, is obviously going to be Tesla. If you didn't know, Tesla holds a pretty big weight in the XLY, in the consumer discretionary ETF. And we all know that Tesla has been pretty much the worst performing S&P 500 stock since the beginning of the year. So I think that that has a big impact on this. All right, we've got credit spreads right here. Credit spreads, Michael Batnick from the Compounds and Ritzholtz Wealth Management, oftentimes he's said that, if there's one type of indicator that he's looking at and or could choose, right, and couldn't look at any of the others, credit spreads would be the one for him. And credit spreads have been aligning here with the current market movement, right? We're seeing the stock market continue to move higher. And we're seeing our ratio chart here of measuring credit spreads also continuing in the same fashion, right? Now here we've got biotech. The reason that we have biotech on this chart is because biotech is arguably, okay, one of the most risk on asset classes or sectors in the stock market. Now, why may that be? Well, one of the main reasons is these are oftentimes, and a majority of the time, profitless companies. These are companies that are burning through money, spending tons of money on research and development and also marketing, really trying to invent some type of technology, drug, etc., that is going to change the company's outlook and eventually put them in massive profitability. And here lately, we've been seeing a downturn in biotech. Okay. So as we're starting to go through a lot of these ratio charts and take a look at these divergences, we have to keep in mind this is a bull market. All right. So in a bull market, bearish chart patterns, bearish tendencies, bearish divergences have a tendency to fail. Okay. Just like in a bear market, bullish divergences and bullish setups and bullish, et cetera, those also have a tendency to fail. So I'm looking at this from an end of the quarter perspective and saying, hey, if we continue to see these divergences play out, well, I know that perhaps over the next quarter, over the next few months, these divergences could end up leading to a market correction or a market pullback, right? Where we see some type of 5 to 10% correction, right? The market is always going to be telling you something, right? And it's not always going to tell you what you want to hear. And so it's your job to expose yourself to what the market is trying to tell you. And that's why I have all of these different measurements and intermarket analysis and different types of thing to really spot it, right? So, from this chart alone right here, we're seeing 3 out of 4 signals that, hey, perhaps this market rally is getting ahead of itself. It could have more to run, but we're not seeing what we typically should see in this type of bullish cycle. And that could be a warning sign, all of these negative divergences of a potential pullback or correction coming over the next month. When you take a look at the Dow transports, okay, so we've got DJI on top, industrials, we've got transports and the S&P 500. The Dow Jones often can be a leading indicator, right? And so what do I mean by that? Well, we topped out here. The transports topped out before the industrials did and before the stock market did, right? At the previous all-time highs. All right. And then what do we see? Well, we see transports actually bottomed here before the stock market did, right? And before industrials did, right around the same time. And then over here, what are we seeing? Well, we see industrials break out right here, all right, right around the same exact time that the S&P is breaking out. And then we see the industrials here break out afterwards, right? After the SPX and the DJT. So it can be a little bit of a leading indicator. And the whole idea behind the Dow transports theory is that if industrial companies are doing good, right, and are performing well in a thriving economy, well, the companies that transport those goods should also be doing well and thriving in the economic state. And what we've seen is not only has the Dow Jones Transportations not made new all-time highs, it hasn't even broken out of its previous trading range from the end of last year. So one thing I'll be monitoring this quarter is transports. I want to see, can the transportation ETF break out and make new all-time highs? If so, that's going to be a suggestion of a very healthy and strong bull market and potentially lead to further continuation in the bull market. Now, this is a growth versus value measurement. So we've got the SPX on top here, okay, and what you see is typically you will see growth outperform value in a bull market, right? And if you want a quick example of that, well, look no further than right here. Okay. What do we see? We have the bear market here, right? We're in this downtrend. What do we see in the growth versus value? We see we're going down. We're in a downtrend. Okay. And what do we see when the stock market bottoms? We see an uptrend, right? And here, what do we see? An uptrend. Okay. So this is why we look at that. Now, the orange chart is going to be growth versus value measured in the Russell 2000, right? That's IWO versus IWN. The blue one here is going to be S&P 500 growth versus value, and this is going to be versus SPY G and SPY V. And what are we seeing here? We're also seeing negative divergences. We just explained how in a bear market, you're going to see growth underperforming value, right? Being that this is the numerator, right? If this chart is going up, this means that growth is outperforming value. And if this chart is going down, this means that value is outperforming growth, okay? And in both the Russell 2000 and the S&P 500, we're seeing negative divergences, right? Russell 2000 growth versus value is making new multi-month lows. And meanwhile, you have the S&P 500 continuing to make lower highs on this growth versus value ratio chart here as well. So yet again, just another little warning sign, signal that I'm paying attention to because the market's trying to tell me something, right? And there's some type of reason that growth is not outperforming value, whether it is via the S&P 500 or via the Russell 2000. And it's our job to pay attention to that and try to figure out, why is that and what is the reason that the market is doing this and if it could potentially lead to anything. Now here we have another inverted chart. Okay, so in white, we have the inverted 10-year Treasury yield, okay, via TNX. So being, again, that it's an inverted chart, what this means is that as the white line is going down, it means that the 10-year Treasury yield is going up, right? So think of rates going higher, right? And what do we see? Well, we had this period here last year, all right? This is last year from about April through July into the beginning of August. There was a 4-month diversion there, okay? So meaning that, we're seeing the white line going down and the blue line going up here, a divergence. And in this case, what that meant was treasury yields were rising and the stock market was also rising. This is typically not the relationship that you see. And after this 4-month diversion, it led to a market correction in which we bottomed in October of 2023. Okay. Now, what are we seeing right now? Well, the blue line here is SPX. We're seeing stocks continue to go up, and the inverted treasury yield is continuing to go down here, aka yields are going up. So we're seeing that the stock market rise, and we're seeing treasury yields rise as well. This is typically not your normal relationship that you have in the bond market. And what are we seeing once again? This diversion, right? And so what did this divergence lead to last time? Well, it led to a market correction. So is this a warning sign that, hey, potentially in the next month, 2 or 3 months, this is what I'm saying over the next quarter, these are charts that I'm going to be checking periodically every week just to see what the state of the market is, see what the market's telling me and signaling. Could this potentially be leading to yet again another market correction, right? This right here is another ratio chart. This is the RSP divided by the SPY, or I'm sorry, this is the MAGS, MAGS, which is your Magnificent 7 ETF divided by the SPY. So as this white line is going up, it means that the Magnificent 7 stocks are outperforming the stock market. Look exactly where we're at right here. I mean, it doesn't get any more textbook for a trend line retest right here, right? You see the initial 2 times that we've tested this trend line. And now the big question is, do we go higher from here or do we go lower? If we break through here, you have to keep in mind that the Magnificent 7 stocks hold a very large weight in the S&P 500. Okay, so in 2023, the whole all you heard, the whole narrative was it's only 7 stocks, right? It's only the Magnificent 7 stocks carrying all of the gains of the stock market and really driving prices higher in the S&P 500. Well, you have to, if you're going to say that in 2023, you've got to say the same thing in 2024 if the Mag 7 stocks really start to underperform relative to the S&P 500, right? If this is breaking down right here, well, by your theory and by that previous market cycle narrative, we should actually start to see the S&P 500 pull back, right? Because now it's not just 7 stocks pulling the market higher. If those 7 stocks had the ability to pull the market higher when they were bullish, those same 7 stocks have the ability to drag the market down lower if they really start to underperform. So this is going to be a pretty key chart right here. I wouldn't be surprised if we bounce and we see, some type of positive reaction, in the market initially. But what you really want to pay attention to, in my opinion, is, hey, does this break down and potentially lead lower and indicate that the Mag 7 stocks are really starting to underperform here? Now, this is the McClellan oscillators. This is the McClellan setup. We've got the McClellan summation index in the middle. We've got the McClellan oscillator itself on the bottom, and then we've got the SPX on top. And again, these divergences are very important things to highlight and pay attention to because they can potentially tell you what's going to happen in the future. They're not going to give you a timeline and say, oh, this is going to happen tomorrow, right? Or, hey, set your calendar for 2:59 p.m., an hour before market close, we're going to see this divergence play out. That's not the case. But these indicators can all be used as potential leading indicators. And so here, right, we see stock market making higher highs. We see our summation index making lower highs. We see the McClellan oscillator making lower highs. And what do you know? That was another thing that ended up leading to that market correction. So let's pause a second and let's remember what we saw about the Treasury yields, right? We also had the Treasury yields with that divergence in that time period in the past, and that ended up leading to this market correction that we're looking at right here, right? Well, we also had a divergence on the McClellan oscillators, right? And on the McClellan summation index. And so it's not like you're only just seeing like one form of a divergence or one signal. Oftentimes there's many signals, but you have to be looking in the right areas and you have to know where to look to see what the market's trying to tell you, right? Oftentimes the market can yell something in your face and shout it out, and there's other times where it's just whispering to you, right? And some of these signals, a lot of these signals are unheard from retail investors because, you know, they're not listening for the whispers. They're just listening for the big loud statements in the market. And it works to the upside too, right? Over here where we're making lower lows, but the McClellan's oscillator here is making higher lows. This was a bullish divergence, right? And it ended up marking the bottom here in October of 2023, leading to this huge rally. And once again, what do we see now? Well, we've got a negative divergence on the McClellan summation index and a negative divergence here on the McClellan oscillator. You know, you combine that with all of the other negative and bearish divergences that we have at the moment, you know, I'm on the lookout for a potential correction this quarter, right? And saying, hey, I'm going to keep an open mind to this. And being that this is a bull market, you know, I'm going to be looking for opportunities to buy the dip during this, you know, potential pullback or correction that we get. And I think that that's the type of mindset and mentality that you want to have. You know, being that we're in a bull market, and you know, that's just my opinion. Okay. Now, we have US stocks and oil futures here. If you didn't know, oil has XLE in particular has actually been the top performing sector of Q1 2024, right? When you compare it to XLK, XLC, XLY, all of these other, you know, sectors, XLE is actually the biggest gainer so far of the year. And this is what I mean by this is a completely different environment than what we saw in 2023. Meanwhile, you would think that XLE being the top performing sector would mean that the stock market is probably pulling back or crashing. Meanwhile, we literally just made new all-time highs. We're probably making new all-time highs tomorrow as well. All right. And, you know, the arrows are on the chart. Again, you typically see these move divergent from each other. Now, there are plenty of periods where they move together, right? Like we have this period here where they're making higher highs, making higher highs. But in general, you know, it's common for these two to have an inverse relationship. Oil oil futures here are retesting a very key zone, very key level. And if this breaks out and continues heading higher, it's very possible that this could be a headwind for the stock market. Right now, we're seeing a divergence, okay, because typically they move opposite of each other. And, you know, a divergence in this case would mean that they're both moving in the same direction, where we see stock market moving higher, and we also see oil futures heading higher here as well. Now, this is your put call ratio. All right, the green portion of the chart on the top basically means that the put call ratio is in bullish territory. The white is more of neutral territory, and then the red is extremely bearish territory. And as I mentioned in the beginning of this video in the intro, oftentimes people use these as contrarian indicators, right? So as a contrarian indicator signal, you know, we've got the S&P 500 on the bottom here. I've went ahead and marked up all of the times where we've crossed into this bearish or bullish time zones. And you can see that most of the bearish signals, you know, they don't really lead to massive corrections, right? Sometimes there is a little bit of a pullback right afterwards, or a little bit of a time where the market goes sideways. But if you were looking to do long-term shorts, right, 3-month shorts or something like that, it hasn't really worked out very well, right? There's this period here where the market topped out last summer, right? And we keep mentioning that. And, you know, what did we see? Well, we actually saw a signal there in the beginning of August in the put call ratio. We saw a signal in many of the divergence charts that I'm showing today, back then in that previous summer. And you combine all of them together, and it's just saying, hey, we could be due for a pullback or correction this quarter. And that's exactly what we ended up getting in the summer. You take a look here, you see all of the different sell signals, and some of them have tiny pullbacks right afterwards. But if you started shorting and were to add to your short position each time that these signals came, you would be underwater right now, right? So again, we are in bullish territory via the put call ratio. Some people like to use it as a contrarian indicator and go the opposite of the way. Say, hey, maybe people are a little bit too bullish. Maybe it's time to look at some bearish trades. This is just another factor, another thing that the market is whispering to you for you to pay attention to and keep in mind, right? Now, what we've got on top is going to be a Riskon ETF I've created. This consists of copper, high yield bonds, the Aussie dollar, semiconductors, and high beta stocks. And then on the bottom, we've got a Riskof ETF consisting of gold, US Treasury bonds, the yen, utilities, and staples. And what are we seeing here, right? What is the market telling us here from a risk on to risk off perspective? Well, we've got a high and then we've got a lower high, right? So we're making lower highs on the risk on ETF. And we've got a high and we've got a breakout high here in the risk off ETF. So it's kind of telling us that the market is more risk off right now rather than it is risk on. But we're still seeing the S&P 500 hitting new all-time highs. So just really speaks to the strength and the power of this current bull market that we're in. And just emphasizing more of, how this bull market is different than the bull market in 2023. When you take a look at these Sho charts, the top one is going to be the equal weight versus S&P 500. And what are we seeing? Well, we're seeing the equal weight actually outperform the S&P 500. When we look at small caps versus large caps via the IWM and IWB ratio chart, this actually bottomed in the November of 2023. And this is another one here that in 2024 is in an uptrend, right? Making highs, or I'm sorry, making lows and making higher lows, potentially on the verge of a breakout here. And then you've got industrials versus tech. And we are seeing industrials outperforming technology stocks. Okay, so it's not just the Magnificent Seven stocks anymore. We've seen very good market breadth. We're seeing small caps, catch up a little bit. We're seeing industrials outperforming tech. We're seeing that energy has been the top performing sector of the year so far. And we're also seeing that the equal weight is also outperforming the S&P 500. So, it's not always going to be as easy. The same trades, the same patterns, the same cycles that worked last year, right? They're not always just going to work again, right? Now, things don't just reset because of a calendar change, right? And the going from 2023 to 2024. But you can use these to measure and keep track basically of like how the market is moving, what's adjusting, what's different in this cycle, what's different in this current market environment. And this is another one of the things that's different. Now, this is the RSP slash SPY ratio chart. This is zoomed out on a weekly time frame. And one thing that I really learned to appreciate is the saying, false moves lead to fast moves. Now, I think Brian Shannon came up with that, but I heard it from JC Peretz at All-Star Charts. And it's just something that I've really been focusing a lot more on and just reminding myself that, hey, these false moves, these false breakdowns, they often lead to fast moves. And earlier in the video, I was mentioning that, hey, in a bull market, you're going to see bearish setups and bearish patterns and things like that. They have a tendency to fail. And this is a really great example of both of those things, of a false move leading to a fast move, and also the tendency of a bearish setup to fail. So, you've got prior support, prior demand here, and we come down, we test it, we bounce really hard. And then what do? Well, it looks like we're breaking right through it, right? And if you're a short seller, or someone looking to short, you're saying, hey, we just came down, retested that key zone. I'm going short right here. And what do you know? That false move here, that little oops, really led to a fast move. And this could potentially just be the start of it, right? And we could really actually see the equal weight continue to outperform the S&P 500 as a whole via the SPY ETF. So this is another one that I'm really paying attention to and watching. Now, this is a This right here is what I call the seasonality projection tool. It's a custom script indicator. It's one of the custom scripts and indicators that's available in the Discord, for those of you that would like to join. And what it's telling us here is that we're potentially going to make another high, right? So we're looking at potentially one more high before we get this pullback in correction. And this kind of follows almost like a little bit scarily, like my current views of the market is, and I don't think that this bullish cycle is over. We're continuing to make new all-time highs. Just because we make new all-time highs does not mean that something is bearish, right? I mean, the exact opposite is you're breaking out, you're making new highs. So I do think it's possible that we can continue to head higher, but knowing that we have all of these divergences and potential sell signals or negative divergence signals in the background that the market's whispering about, I'm not looking to overly aggressive long things, and I'm not looking to enter new long positions right here for the end of the year or for any type of trades longer than a year. I would rather, let's see if the market can make new highs and come up to the 53 to 5400 area. And if we can do that, we'll see if we can continue there and have a correction over time or a correction through time, versus actually getting a pullback. And if we do get this pullback or market correction, well, then I know that, hey, there's some areas that I'm going to be interested in here and that I want to pay attention to, and know that this bull market is different than the last bull market we just saw. And I want to, get in some of the right names that could potentially benefit from, a bottom in a pullback or correction. Now on top here, we've got the Skew Index. On bottom, we got the SPX. All of the white arrows really just show the buy signals. And this is a really good buy signal chart, in my opinion. But we're up here in this frothy territory right now, and it's very often that we see some type of a market correction or pullback, once the skew is up here at these very elevated levels, and that's exactly where we're at and exactly really where we've been sitting at for a long time. For a while, we've really just been consolidating through these areas here. Now, most of the time, you're going to see this move with the stock market. So if you're bullish, and you want to see things continue to go higher, well, you really want to see the skew also continue to go higher here as well, right? As the skew goes down, it's very common that you end up seeing the stock market go down. We take a look over here, and we can see that this was our bear market. We see that the skew was going down as well as when the SPX was going down. Okay. Now, on top, we've got the SPX again. In the middle, we've got the percentage of stocks above their 200-day moving average. We're currently at 83%. So this is very bullish, right? Over 83% of stocks are trading above their 200-day moving average, right? So this basically just lets you know, like, hey, 83% of stocks are bullish right now in the S&P. But we're getting very close to some frothy levels, right? Typically, when you get to about 85% or higher in this measurement, that's when things are getting maybe a little bit too frothy, right? And even when you look at the percentage of stocks above their 50-day moving average, that's also at 83% here, which is, I think a little bit of a coincidence that both of them are trading at the exact same percentage. This is not something you normally see, but even divergences in these charts also lead to signals, right? Here we have, low. We've got a low here, and then we've got a higher low here, and here we've got a low and a lower low. So we're seeing a divergence here that ended up being a good buy signal. And what do you know? It was a great buy signal, right? And we were also in this area here where we typically start to see a little bit of a bottom. Right. Now, one thing I want to highlight is I mentioned something as a correction through time or correction in time. Look what we saw up here, right? When we came to these frothy levels on the percentage of stocks above their 50-day moving average, rather than the market crashing, right, as some would say, we had a correction through time, and we just consolidated sideways here for a few months, and then we continued the next leg up in the market, right? And that's once we came up here and got to these frothy levels. You see, we frothed out, continued sideways, corrected through time, and then it continued the bullish market cycle up there. Now, currently, neither one of them is at those frothy levels. Things are getting frothy, but we do have a negative divergence once again, right? And we're going to highlight that real quick so it's clear for you guys because I didn't draw it on the chart. But, lower highs here, higher highs here, right? And it's just that simple. So, we're seeing a negative divergence here on the percentage of stocks above their 50-day moving average. And both, measurements here are getting very close to being very frothy. Now, on the top, we've got inflation protected treasuries. This is your TIPS, as they refer to them. And this often moves opposite of technology and technology stocks. Okay. And you've got the NASDAQ 100 NDX on the bottom, and you can see these divergences here. They typically these divergences, oftentimes in the tips, can be a leading indicator potentially in what's going to happen in the NASDAQ and in the NDX, right? And that's what we're seeing. We're seeing the NDX or seeing tips, in a downtrend here while the NASDAQ is in an uptrend, suggesting that the NDX could be due for a pullback. And here we're seeing the NASDAQ go lower while the tips are going higher, basically just suggesting that we should see a little bit of a move up. And, oftentimes whenever you see these divergences, the bond market is going to be the leading indicator in this case, right? Versus the NASDAQ. And so we're seeing yet again another long divergent period here, of about 3 or 4 months. And we saw that previously in the past for about 3 or 4 months, and that ended up leading to a correction in the NASDAQ. Same thing with TLT. You can use TLT as a leading indicator for the stock market. It's something that I've been doing for years now. And, what are we seeing, y'all? Well, we're seeing yet again TLT in a negative divergence relative to the stock market. And many times in the past, this has ended up leading to a little bit of a pullback and correction in the stock market. So another one that I'm monitoring here. You can even look at the advanced decline line and TLT just to see this divergence play out. Here's another really good example where we're making these lower highs while the advanced decline line is making higher highs. This is basically the number of stocks advancing versus declining, okay, is all that really simply is. And we're seeing a negative divergence here, potentially suggesting that we could see more stocks declining. And as we talked a little bit, we just mentioned it, but copper often is used as a good by a little bit more of the old school traders, something to monitor the economy, right? And we've got a divergence here in TLT and copper futures. This is an example of these divergences playing out in real time. Okay, so we're looking at all of these potential divergences. Well, not potential divergences, they are divergences across these different intermarket analysis, but we're looking at them to say, hey, we could potentially see a correction or pullback in the market because of this. And, it's easy to highlight things in the past after they've already happened and say, oh, look what happened because of these divergences. Well, copper just did it, right? We had this period here where we're making lower highs on the TLT, but copper futures were making a high and a higher high. And look what we did. We immediately ended up seeing a pullback. This is in real time. You know what I mean? Right after this divergence. And this is something that, basically I'm just saying could potentially happen to the stock market, right? And something that you want to be aware of. That way you can manage your risk and also manage your investment strategy. Now, we've got the copper futures here in white, and we've got the SPX here in yellow. And these two aren't going to move exactly perfectly similar, but they do move pretty closely oftentimes, right? We see the SPX in an uptrend here. We see copper futures in an uptrend here. We see the crash in 0809. We see the crash right over here. And then we see a very strong uptrend in these. Here is a little bit of a divergent period where they're not really trading together. Same thing as over here where they're not really trading together. Then both of them end up seeing a drop here. Bottom right around the same time in COVID, going a very strong uptrend. And, copper's been making some pretty aggressive moves here lately, right? So if this can continue to head to the upside, that could be a good indicator for the economy and for the stock market. Now, the last thing we're going to touch on in today's video is going to be volatility. So we've got the VVIX on the top. This is the volatility of the volatility index. Then you've got the VIX for your stock market volatility index, and we've got the SPX on the bottom here. Now, what I just want to highlight is the VIX and the VVIX are basically both at support right now. Okay. We're right around here at support. We're right around here at support. Typically you're going to start to see the VVIX tick up a little bit more before you start to see the VIX catch up. So I'll be monitoring these. And again, it's not always the case, but it's very often that whenever you see the VVIX going up, you see the VIX going up, that means that there's some type of a correction or pullback happening in the market, right? It's not always the case, but it is very common to see that. It's very interesting that both of them are basically coming here and trading at support. So will these break through support and create new lows, right? New multi-year lows? Can the VIX make new multi-year lows? Or are we potentially about to see a little bit of a bounce here in volatility and a spike in volatility, this next quarter? Now, that's all of the info for today's video. I really appreciate it if you made it this far. Don't forget, you can join the Discord, okay? That's where all of these charts were posted before I got on YouTube, all right? Every single chart from this video is in the Discord, and I explain them all. And that's where you get all my analysis, okay? All my different trade ideas, everything that I'm looking at, and, many valuable scripts, indicators, custom resources, different things like that is available. If you don't want to pay for the Discord, because it's only $10 a month, let's just sign up for the newsletter. Okay, that's completely free. And either way, I'm trying to provide you guys with some value, and I think that you will be very pleased with the value provided in either or of those, or you can sign up for both. Now, if you enjoyed today's analysis and you still have some more questions, right, and you feel like maybe you need a little bit of a Q&A session, you can come to the commissions tab here, and on my Ko-Fi page, there's a link in the description for that. And in there, you can actually book a 30-minute or a 1-hour session. We don't have to just do a Q&A, right? That's one of the things. We can go over swing trading strategies, day trading dynamics, whatever it is you would like. This Ko-Fi page is also where you can request a YouTube video on the topic of your choice. And you can basically leave a detailed message on there, be like, hey, can you cover this? Here's my time horizon. Here's why I'm looking at it. Here's what I'm interested in. Here's what I want from you. That way it doesn't get lost in the comment section, right? And you can also click on this little buy a coffee button. It's basically a way to leave a tip or donation for all the free valuable content I do put out, such as this video, and as well as the newsletter and articles that I write in there. Thank you all for watching once again. Smash the like button, subscribe, and if you enjoyed today's video, I really think you'll enjoy this next video here as well. So be sure to click on that one.